Hello and welcome to this session in which we will discuss the auditor's responsibility when it comes to material errors and fraud. In the prior session, we looked at the primary objective of an auditor, and that is to obtain reasonable assurance. And in the prior session, we discussed what is reasonable assurance is, that the financial statements are free of material misstatement. In this session, we will try to learn a little bit more about material misstatement. Whether due to fraud or error, then we will define fraud and error, enabling the auditor to do what? Form an opinion on the fairness and compliance of the financial statement with relevant reporting framework, whether that framework is GAAP or IFRS. Then the auditor would report on the financial statement by issuing a report and stating their opinion. So in this session, we will focus on what does it mean by material misstatement, what does it mean fraud, and what does it mean errors. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Starting with material versus immaterial misstatement. What does that mean? Well, a misstatement is material if the aggregate of incorrected error and fraud would likely influence the decision of a reasonable person using those statements. So the first thing you notice is we did not quantify materiality. We did not put a dollar amount on materiality. What does it mean that something is material? It means that error or fraud that was undetected would influence. Influence means change the decision, change the mind of a person that's reasonable, and that person is using those statements. So notice, we cannot put a dollar amount because materiality is different for different companies. Now, although on this picture I showed you a small apple versus a large apple, I'm not trying to imply it's quantifiable, small versus large. Sometimes an error or a fraud could be small but important, and we'll talk about materiality later on. But the point is, material means, is it going to change someone's opinion? If it does, it is material. Bear in mind, it's neither cost effective nor practically feasible for auditors to bear the responsibility for identifying every immaterial error. They can if they want to, but it's going to cost a lot of money, and it's not really practical, and it's not really worth it. Therefore, we are not responsible for every immaterial error. As long as the error does not change or influence someone's opinion, it's considered immaterial. Now, if we find it, of course, we're going to have to look at it, but we're not looking for every immaterial error. Now, bear in mind, at the end of the day, we are only providing reasonable assurance. And remember, in the prior session, there are 3 reasons that we can only provide reasonable assurance, and that's sampling, the use of estimate, and fraud. And that's usually the first line of defense for the auditor. When the auditor are sued, the first thing they say is we are only providing reasonable assurance. And reasonable assurance means not absolute assurance. Therefore, we cannot find all errors. We'll try to find the material ones, whether they are due to errors or fraud. Now, let's discuss the difference between errors versus fraud. Well, auditor standard differentiate between 2 categories of misstatement, errors and fraud. And those misstatements can be material, means what? We just defined this. They significantly impact the reader's understanding of the statement and their opinion, or they can be immaterial, indicating a minor discrepancy that does not substantially affect the statement or the opinion of the user. Let's start to talk about errors. Well, what is an error? Whoops, you burned that piece of bread. Well, it's unintentional inaccuracies in the financial statement. They are not deliberate. You did not burn this piece of bread on purpose, and they can arise from oversight, misunderstanding, simple calculation, tiredness, laziness, not proper training, not proper supervision. Examples of errors would include not counting inventory items, certain inventory item, or if you count them, you miscounted them, or if you counted them properly, you did not take the quantity times the appropriate price. So you just made an error. While errors are unintentional, that's fine, they could still have a significant impact on understanding the company financial position if they are material in nature. What do we need to know about errors? Errors, you make no effort to hide them. The person that commit the error will make no effort. And that's important because they can be easily found in contrast to fraud. We're going to see what happened when we have fraud. So no effort to hide them. When it comes to fraud, fraud refers to intentional acts that result in a misstatement of in the financial statements. Notice, errors is unintentional. Fraud is intentional. And those actions are taking knowingly, you know what you are doing, for a purpose, and oftentimes to deceive financial statement users. That's why you commit fraud. And the reasons could be either for personal gain or to make the performance of the company appear better than it is. That's why we commit fraud. That's why management or the people in charge commit fraud, either for personal gain, to get their bonus, to get their stock option, or to make the company look better if they want to get a loan or something to that effect. Now, the difference between fraud and error is the fraud, there's an effort to hide the fraud, to mislead the auditor, to cover their tracks. People that commit fraud, they'll try to cover their tracks. Therefore, it's more challenging for the auditor to find the fraud. Now, the auditor also mentions this in their financial report. They will mention that frauds are different than errors, and they will explain why. And there are two types of frauds. There is misappropriation of assets and there is fraudulent financial reporting. So we need to know the difference between misappropriation of asset versus fraudulent financial reporting. What is misappropriation of asset? It's a fancy word for theft. Simply put, taking something that's not yours. This type of fraud, often referred to deflection as well, or employee fraud, involve the theft or misuse of the company's asset by the employees. It's typically characterized by employees manipulating their position within the organization for personal gain. An example will be a cashier takes cash from the customer during a sale but does not record the sale in the cash register, effectively pocketing the money without being traceable in the company's record. So notice this type of fraud, taking the cash, it did not even make it to the company's record. It did not make it to the balance sheet as cash. It did not make it to the income statement as revenue. So notice this fraud is not even on the financial statements at all. So it doesn't exist as far as the auditor is concerned. Then the other type of fraud is fraudulent financial reporting, which is cooking the books. This category commonly referred as management fraud. Why? Because management is in charge to change the record, to cook the books. It involved the intentional manipulation of the company's financial position to do what? To present a more favorable picture than it is. So you want to look good. You want to inflate your revenues. You want to reduce your expenses. You want to show you are more profitable. You want to show less liabilities, more assets. This is often perpetrated by higher level management to deceive investors and creditors and other stakeholders. Usually you're trying to deceive the creditors and the investors because those are the groups that are most interested or have something on the line for the financial statements outcome. Examples will be intentionally recording sales transactions that occur after the balance sheet date if they took place before year end. To do what? To artificially increase revenue so you can increase earning for that period. And this manipulation makes the company appear more profitable because you are reporting more revenue. Now, what is the auditor responsibility for identifying material errors? Remember, immaterial errors, it's not practical. How about material errors? Well, auditors allocate a significant portion of their time in planning and execution of audits with the aim of identifying unintentional errors made by management. And usually errors can take many forms such as calculation mistakes, omissions of certain transactions, misunderstanding, misapplication of accounting standard, and incorrect summarization and description. Now, auditors review and analyze financial statement and operation to ensure that the financial statements are free from such errors and provide a fair and accurate presentation of the company's financial position. So what's their responsibility? To find those errors. Are they going to give absolute assurance? No. Any guarantees? No. Reasonable assurance to find errors. How about fraud? What's the responsibility for fraud? Same thing. Do not differentiate between auditor responsibility for fraud or errors. It's always a reasonable assurance. In both scenarios, the auditor is required to obtain only reasonable assurance. Best effort that the financial statements are free of material misstatement, whether due to error or fraud. Now, as I mentioned earlier, fraud can be more challenging to uncover, especially when management or employees involved in the fraud are trying to hide it. They're making an effort to cover their tracks. Again, as I mentioned earlier, the auditor mentioned in the report that there's a difference between errors and fraud, and they illustrate this point. Now, the auditor remains obligated to appropriately plan and conduct the audit to identify material misstatement, regardless whether they are due to errors or fraud, but they can only provide reasonable assurance. What are the results of fraudulent financial reporting versus misappropriation of asset? Both financial reporting and misappropriation of asset pose a significant risk to financial statement users because they harm the stakeholders, investors, creditors, so on and so forth. However, fraudulent financial reporting mislead the users by presenting inaccurate information. So they're showing you the wrong picture, which can negatively affect the decision of the users. In other words, the users is misled into believing something about the company which is not. On the other hand, asset misappropriation, simply put, theft, directly harms stakeholders and creditors. How? Well, you are basically taking something that's rightfully the investors and the creditors. You're stealing basically from them. Now, why do employees feel it's not a big deal when they misappropriate asset? Because it's a faceless crime. You are stealing assets from investors and creditors. And oftentimes, those investors and creditors, you don't see them. And when you don't see someone, when you don't put your eyes in someone else's eyes, it's easier to take from them. It's called faceless crime because you don't believe that the actual people exist, but investors and creditors are actual people with families and kids and jobs, so on and so forth. Now, if the owners are working in the company, you're going to see them every day. That's a little different. But usually when the owners are separated from the companies, like in large companies, then it looks as you are not really harming anyone because you think it's the company, it's the stockholders who you don't see. But stockholders are real people as well. Typical perpetrators for errors and fraud. Fraudulent financial reporting is typically perpetrated by management and usually upper management. Often, as management holds the authority to make accounting and reporting decisions independently. And that's why they can manipulate the financial statements. They can cook the books. Okay, so for example, management might choose to omit critical footnote disclosure about pending litigation. Employees can do that. In contrast, theft of asset, usually, not always, committed by employees, lower level employees rather than management, and usually theft or misappropriation of asset, the amount is often immaterial. It doesn't mean always. In some instances, a misappropriation could involve a substantial asset, like a major computer or a server or some piece of technology or a piece of jewelry. It could be a serious event for the company. Nevertheless, they're both wrong, whether they are small, medium, or large. We don't quantify errors or fraud. Errors or fraud, especially fraud, theft, and fraudulent financial reporting, is unacceptable, whether it's a small or large. And there's no such thing as small fraud. Once it's a fraud, it's a fraud. It's unethical. And it's a slippery slope type of thing. Once you commit a small fraud, you don't stop. That's how usually fraud happen. Fraud don't usually start large. It starts small. Same thing with theft. So be on the lookout for yourself. Don't go into that slippery slope. Let's take a look at this MCQ from Farhat lectures. Which of the following is the auditor's best defense when material misstatement are not detected by the auditor? So when material misstatement is not detected, how can the auditor defend themselves? Well, the audit report was performed on time. Well, can we say, because the audit report was performed on time, that's a good defense for us? Not at all. You're supposed to perform the report on time. So A is out. The auditor fees was not paid on time. Well, they did not pay us the fee on time. Therefore, we did not do a good job. You can't say that. You're supposed to do your job. You're a professional. B is out. The audit was conducted in accordance with generally accepted accounting principle. Well, the audit was conducted based on that? Well, not really. Generally accepted accounting principles are accounting standard that we need to follow in preparing financial statements. So that's not the answer. By process of elimination, D is the answer. The audit was conducted in accordance with generally accepted auditing standard. Yes, and that's a form of defense. What does that mean? Remember, we can only provide reasonable assurance. And if we follow GAAS, we did provide our reasonable assurance. Therefore, our first line of defense is we did our job as expected of us, and we can only provide reasonable assurance. That's the first line of defense. Now, what's the second, third line? Well, we have to look at the error or at the fraud. Well, the error is, that we have less defense for errors, but for fraud, if the company was trying to hide the fraud, we can blame the management. You did not give us certain information. Now, it's your problem, in a sense that the reason we did not uncover the fraud because it was hidden on purpose and hidden well by management. So management was trying to trick us, and we started this audit engagement based on good faith and best effort. But the first line of defense, we did our job as expected. We're only providing reasonable assurance. What should you do now? You should go to Farhat Lectures and look at additional MCQs, true, false, additional resources. That's going to help you understand the objective of an audit, the difference between errors and fraud when it comes to auditors' responsibilities. Invest in yourself, whether you are a CPA exam candidate or an accounting student. FarhatLectures.com is your solution. Good luck, study hard, and of course, stay safe.